Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
Coming up on the show today, we're diving into the Robotaxi war between Tesla and Waymo, where Elon Musk is betting the farm on cameras, while Waymo's cars are literally driving into floodwaters. Then, we'll look at a shocking Stanford study that suggests AI has wiped out 13% of jobs for young workers, creating a dangerous experience paradox. After that, we unpack how the data company Snowflake jumped $11 billion in value in one day and why investors are paying a fortune for it. We'll also cover Google's quiet move to cut over a third of its small team managers and hear CEO Sundar Pichai's blunt response to employee demands. And finally, Donald Trump Jr. and Eric Trump are co-founding American Bitcoin with a plan to control a stunning 98% of the company. The story begins with a decision that caught everyone by surprise. After 8 years on the market, the top robotaxi company in America, Waymo, operates in areas covering just 3% of the US population. Now, its biggest rival, Tesla, is promising its own robotaxis will be available to half the country by the end of this year. It's a high-stakes gamble in a race for what some analysts say could become a multi-trillion-dollar market. The strategies could not be more different. Waymo meticulously maps every street, testing for years before launch. Tesla says it's camera-only A. I can skip all that. You know, the core of their strategies is fundamentally different. Waymo uses a suite of expensive sensors, including LiDAR, which is like a high-tech radar using light. This sensor suite can cost up to $100,000 per car. It gives the car a super detailed 3D picture of the world, but it's costly and slow to expand. Tesla's approach uses only cameras, estimated to cost just a few $100s per vehicle. The bet is that a smart enough AI can learn to drive from video just like a human does, making it far cheaper to scale. Elon Musk has even called Waymo's approach fragile and its ability to expand limited, claiming that if Tesla's system works in a few cities, it can work anywhere. It's all about the data. Waymo uses a smaller fleet to gather extremely high quality, curated data from its advanced sensors. They are solving for safety and reliability first in a controlled environment. Tesla, on the other hand, is collecting massive amounts of real-world driving data from millions of its customer cars already on the road. It's a strategy of quantity over quality, betting that with enough noisy data, its AI will eventually learn to handle all the rare, unpredictable edge cases that still challenge autonomous cars. And investors have bought in. Some analysts attribute the vast majority of Tesla's stock market value to this exact vision, a bet that this new technology can scale much faster than its competitor. What makes this a massive gamble for Tesla is its reliance on what's called an end-to-end neural network. Think of it like a black box data goes in and a driving decision comes out, but even the engineers can't always explain the AI's exact reasoning. So, if a fatal accident happens, how can regulators or courts determine who is at fault? This lack of explainability is a massive legal and insurance hurdle that has yet to be solved. This is where the situation takes a more complex turn on the ground. In Austin, police say Waymo vehicles have ignored officers' hand signals and driven into dangerous situations. One even drove into floodwaters, forcing the passenger to find a way out. An Austin police lieutenant said if that person had died, they could have been looking at a serious criminal incident. Police have had to create a new citation system just to handle Waymo vehicles, saying they could have issued hundreds by now if they pursued it every time. The root of the problem is a lack of a universal, standardized way for first responders to interact with a driverless car. Imagine a police officer trying to wave a car through an intersection and the car's programming doesn't understand hand signals. While some companies like Waymo have actually created detailed protocols and even 24-hour hotlines for police, there is no industry-wide rule. This creates a patchwork of confusing and potentially dangerous situations, highlighting a critical flaw in the rollout of this technology. So, who wins this war? The slow and steady veteran or the high-speed disruptor? Analysts at Morningstar predict Waymo will lead for the next few years, but that Tesla's riskier, cheaper approach will ultimately pay off, allowing it to surpass Waymo's market share by the end of the decade. The race for our driverless future is on, and the finish line is nowhere in sight. Speaking of the real-world impact of AI, a new Stanford University study just dropped a number that's shaking up the job market. employment for young workers in jobs exposed to? AI has plummeted by 13% since 2022. This isn't a vague prediction. This is based on an analysis of millions of real payroll records from ADP. The report found that workers between the ages of 22 and 25 in fields like customer service, accounting, and even software development are seeing their job prospects shrink. However, if you zoom out, you'll see the data itself might have a blind spot. These payroll records primarily track traditional salaried jobs. They often miss the massive shift of young workers toward freelance and gig economy roles. In fact, one report from 2024 found that over half of all Gen Z professionals did some form of freelance work last year. So while this 13% drop in traditional jobs is real and alarming, it might not be capturing the full picture of where young people are actually working. The situation presents a fascinating duality. For more experienced workers in the exact same fields, their employment has stayed steady or even grown. The data shows a clear divide. While jobs for young health aides rose, the same wasn't true for other entry-level roles. This brings us to a key strategic choice for companies. Do they use AI to replace their workers, or do they use it to help them? It's a strategy called augment versus automate. Research shows that when companies give AI tools to their employees to augment their skills, productivity skyrockets. One study of 5,000 customer service agents found that AI assistants boosted their performance by 15%, with the newest employees seeing the biggest gains. The data suggests that for now, companies are choosing to augment their experienced staff while automating away the entry-level roles. The study suggests a chilling reason for this. AI is exceptionally good at replacing what it calls codified knowledge. In other words, the book learning that comes directly from a formal education is exactly what makes younger workers vulnerable. This is forcing a crisis in higher education. If I can instantly generate the information you spend 4 years and thousands of dollars learning, what is the new value of a university degree? Institutions are scrambling to adapt, focusing on teaching critical thinking and ethical reasoning skills. I can't easily replicate the knowledge that comes from years of hands-on experience. However, is something I seems less capable of replacing. And this creates what experts are calling the experience paradox. If AI automates all the entry-level jobs where you're supposed to learn the ropes, how will the next generation ever acquire the very experience that protects senior workers from AI? It's a huge question for the future of our workforce, but that's not the whole picture. An economist from Goldman Sachs recently noted that these changes are already showing up in employment data, especially in tech and among younger employees. This all leads to a final chilling warning. That same economist warned that most companies have not even begun to deploy artificial intelligence for day-to-day use. This means the 13% drop we're seeing now might just be the beginning. While AI is creating challenges in the job market, it's also creating a gold rush for certain companies. For instance, a company just saw its value rocket up by over $11 billion. In a single day, the company is Snowflake, and their stock surged 14% on the back of one massive trend: artificial intelligence. The AI gold rush isn't just about who builds the smartest algorithm. It's about the one thing AI can't live without: data. And companies like Snowflake, which help businesses manage enormous data sets, are at the center of the storm. So the thing is, Snowflake is what investors call a picks and shovels play for the AI gold rush. But unlike hardware, like NVIDIA's chips, software can be copied. What makes Snowflake so special is its platform agnostic design. This means it can run on top of any of the major cloud providers: Amazon Web Services, Microsoft Azure, or Google Cloud. For big companies that don't want to be locked into one ecosystem, that's a huge deal. On top of that, once a company moves all its data onto Snowflake and builds its operations around it, the cost and complexity of switching to a competitor become incredibly high. Demand is accelerating so fast that Snowflake just raised its annual product revenue forecast to a stunning $4.40 billion. The success of chip makers like NVIDIA has reinforced investor confidence that spending on data infrastructure is about to explode, and Snowflake is positioned to catch the wave. As one portfolio manager put it, Snowflake is a key beneficiary of the entire AI and cloud migration trend. Believe it or not, while Snowflake offers freedom to operate across clouds, there's a powerful force at play called data gravity. The more data you put into a platform, the more it attracts other applications and services, making it harder and harder to leave. Moving massive amounts of data out of a platform like Snowflake can also trigger significant egress fees, which are basically charges for transferring your data out. So while you can check in anytime you like, it can be very expensive to leave. What really brought this to a head was a move by a huge private competitor, Databricks, which just announced it's raising funds at a valuation above $100 billion. This move is intensifying the competitive backdrop, setting the stage for a massive battle over who will provide the fundamental building blocks for the AI revolution. When we place Snowflake's origins alongside Databricks' goals, the strategic difference becomes clear. Snowflake started as a data warehouse, which is fantastic for organizing and analyzing structured data. Think of neat spreadsheets and databases. Databricks, on the other hand, pioneered the data lakehouse. This architecture is designed to handle everything: structured data, unstructured data like images and text, and the complex models used for AI and machine learning. Right now, that gives Databricks a natural edge for companies focused heavily on AI, but Snowflake is racing to catch up, adding new features to close that gap. This brings us to a statistic that might just change your entire perspective on this market. Investors are so optimistic about Snowflake that its stock is trading at over 142 times its profit estimates. That's more than double the valuation of competitors like MongoDB and Datadog. To put that number in perspective, the average for the entire technology sector is around 27 times profit estimates. This valuation isn't based on what Snowflake is earning today. In fact, the company hasn't even achieved consistent profitability yet. Investors are making a massive multi-billion-dollar bet that Snowflake's future growth in the AI world will be so explosive that it justifies a price tag that is, by all traditional metrics, through the roof. In this high-stakes war for data dominance, the question isn't just who will win, but how high the price of victory will be. Speaking of soaring valuations, tech giant Google is also riding high, but inside the company, a very different story is unfolding. In the last year, Google has quietly eliminated more than a third of its managers who oversee small teams. Now get this. This move is part of a strategy to increase what's known as the span of control, which is just a fancy way of saying how many employees a single manager oversees. Research suggests the sweet spot for technical teams is somewhere between 5 and 15 people. By removing managers of smaller teams, Google is pushing its remaining managers to handle more direct reports, aiming for what they believe is peak efficiency. This also turns many of those former managers back into individual workers, which can be a tough transition. An executive just confirmed the number in an all-hands meeting, stating the company has 35% fewer of these managers now than it did a year ago. The stated goal? To slash bureaucracy and run the company more efficiently. Actually, this isn't just about cutting human jobs. It's about a future where AI does the managing. This trend is being called the Great Flattening, where AI-powered tools automate routine managerial tasks like performance monitoring, project tracking, and even reporting. Some executives now say they trust AI's input even more than their own colleagues. We're seeing the first signs of AI displacing not just junior roles, but the core functions of middle management itself. This is all part of a massive cost-cutting drive that includes voluntary buyout offers in at least 10 different product areas, from search and marketing to hardware. The company's chief people officer called the buyout program quite successful, noting that between 3 and 5% of employees on those teams have accepted the offers. These voluntary programs can be a strategic tool. While they seem more ethical than outright layoffs, they can be designed to encourage specific employees, often those who are higher paid or have been with the company longer, to leave. This helps companies avoid the legal and PR risks that come with targeted cuts, but it raises serious questions about whether these offers are truly voluntary or a form of subtle pressure. And this decision brings both financial benefits for the company and comes with inherent risks to morale. While the company is downsizing, its stock price is soaring, jumping 10% this year after huge gains in the previous 2 years. This has employees questioning the cuts and asking for better benefits, even floating the idea of a month-long sabbatical program similar to one offered at rival company Meta. It highlights a massive cultural shift. The famous perks and play model that defined big tech for a decade is being dismantled in favor of hardcore efficiency. This isn't just a Google thing. It's an industry-wide pivot. The response from Google executives was blunt. They said their current benefits are competitive and that a paid sabbatical is not going to happen. But the final word came from CEO Sundar Pichai himself. When the comparison to Meta's policies came up, He shot back with a question that drew laughs from the audience. He asked, should we incorporate all policies of Meta while we're at it, or should we only pick and choose the few policies we like? He then added, maybe I should try running the company with all of Meta's policies. No, probably not. From one set of big names to another, two of Donald Trump's sons, Eric and Donald Trump Jr., are co-founding a company called American Bitcoin. And they've just pulled in investments from some of the biggest names in crypto, including the Winklevoss twins. This isn't some small startup. The company is set to go public on the Nasdaq as early as September through an all-stock merger with Griffon Digital Mining. They're skipping the slow IPO process and going straight for the big leagues. This is a particularly savvy move for them. A traditional IPO is a long, expensive, and heavily scrutinized process. By using what's called a reverse merger, American Bitcoin can get onto the public market much faster and for less money. Essentially, they are taking over an already public company, Griffon, and using its existing stock market listing as a shortcut. It's a strategy that allows them to bypass some of the intense regulatory hurdles that a new company would normally face. And here's a single statistic that reveals the sheer scale of this operation. Between the Trump sons and their primary partner, the mining giant Hut 8, they will collectively own a staggering 98% of the new company. Hut 8 alone holds an 80% stake. That's near total control. Interestingly enough, this isn't just an investment for Hut 8. It's a massive strategic pivot. Hut 8 is effectively spinning off its high-risk, high-reward mining operations to American Bitcoin. Meanwhile, Hut 8 itself is transforming into a more stable infrastructure company. It will own the data centers and energy infrastructure and then lease them back to American Bitcoin. So you have one company taking the big swings on mining and another providing the stable foundation. It's a way to de-risk their business while still owning the lion's share of the upside. If that was just the appetizer, the main course is their stated ambition. American Bitcoin has officially vowed to become the world's largest, most efficient pure-play Bitcoin miner. To get there, their strategy is aggressive. They won't just be mining for new Bitcoin. They'll be actively buying it on the open market, shifting between whichever tactic gives them the best return. They are playing both sides of the crypto coin. Their adaptive model, known as a hybrid treasury strategy, is actually quite brilliant. Think about it. The profitability of mining Bitcoin is constantly changing. It depends on the price of electricity, the cost of computer hardware, and how many other miners are competing. When mining gets too expensive, American Bitcoin can simply switch gears and buy Bitcoin directly off the market. But when electricity is cheap and their operations are efficient, they can flip back to mining. This flexibility acts as a powerful buffer against the wild volatility of the crypto world, something pure miners don't have. This entire venture is launching amid reports that the US is accelerating crypto-related legislation. Critics have already raised accusations of conflicts of interest, allegations the White House has reportedly brushed aside. This is crucial because a pro-crypto administration could offer more than just verbal support. We're talking about tangible competitive advantages. For example, a friendly regulatory environment could fast-track permissions, while energy policies that favor crypto mining could grant them preferential access to power resources. This isn't just about a famous name. It's about the potential for policy to align directly with the financial interests of a company co-founded by the president's family. This all begs the question, with this much political and financial power converging under a single ticker symbol, what is the real endgame for American Bitcoin?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.